Hello everyone, welcome to today's US Open live webinar. 10 minutes before Wall Street opens. As always, I am your host Nikos Zabouras, Senior Financial Editorial Writer at FXCM. It is of course Tuesday, October 31st. And we are in another action-packed week with the Bank of Japan kicking things off for this central bank blitz. With another timid but significant tweak to its yield curve. And of course, Fed and the Bank of England follow over the next couple of days. We also have Apple reporting on Thursday, while in terms of economic releases so far, inflation from Eurozone, which continue to decelerate, stood out just a few days after the Central Bank of Europe kept rates unchanged after 10 consecutive hikes. This is pretty much what we will be talking about today. And before we begin, as always, please read carefully through the risk warnings and the disclaimers. Once again, please read carefully through the risk warnings and the disclaimers, and bear in mind that anything discussed in this session does not constitute investment advice and should not be taken as such. Let's give it a few more seconds and then we will begin. Okay, let's get the ball rolling because we have quite a few things to catch up on and discuss. We're gonna start with USD JPY after the BoJ, the Bank of Japan, made another tweak to its yield curve control in another step towards policy normalization. Then we're gonna talk about Euro USD and in today's preliminary inflation figures, which showed further deceleration and come just a few days after the central bank had paused its tightening cycle, and of course just a day ahead of the Fed. And then we're going to talk about the Nasdaq, and then we're going to discuss what's ahead with the Fed, the Bank of England, and Apple earnings. So in terms of the Bank of Japan, it largely maintained its ultra accommodative stance today, but took another step towards normalization, albeit a timid one. Again, it increased the yield curve control flexibility by viewing the 1% target for the 10-year yields as a reference point and not as a hard ceiling as it previously did. After July's change, it had a ceiling of 1%, after which it would step in and buy bonds. But now that's not a hard ceiling anymore. So essentially it allows the 10-year JGBs to go above 1%. It also raised its median inflation forecast to 2.8% for the current fiscal year, which ends in March of the next year, and fiscal 2024. Now, despite loosening its grip on the YCC further, it still vowed to patiently continue with monetary easing in order to achieve the price stability target in a sustainable and stable manner in its usual lingo. So essentially accommodative stance remains, and the policy differential with its major counterparts and the Fed is still in place. So markets were underwhelmed by today's action, and the policy differential that I talked about with the Fed that has been detrimental to the yen is maintained, and USD JPY surged, as you can see on the chart, after today's BoJ decision, after a recent pullback. It stayed above the 200-period EMA, as it has done since late July onwards, and now has 152.2 in its crosshair, and that is 1990s territory. On the other hand, the Fed looms tomorrow. We're going to talk more about it later on in the session, and the pair is in intervention watch because there is a chance that Japanese authorities will step in and support the yen. There was some speculations that this may have happened early in the month due to this price action that you see on the grade, on the highlighted area, but we learned today that with today's announcement that the finance ministry did not intervene in October in the FX market. But in any case, we are in intervention watch, which could send the pair lower. But again, the policy differential will need to change for a change in the pair. And of course, if that happens, it could be up for a big repricing. But for now, this hasn't happened. Now, there is, of course, a potential for renewed pressure back towards the 200-period EMA. Daily close below low, it would pose the immediate upside bias, but the downside is well protected. Now let's move to USD. It made a strong start to the week, but it finds itself in familiar territory, facing pressure after breaching the pivotal 23.6% of 2023 high-low drop. Now, the good start and the breach of this level may give it the opportunity to tackle the other critical region of 1.073563, which includes the 200 days EMA and the 38.2% Fibonacci, but the battle remains technically and fundamentally. For one thing, you see that it again rejects the aforementioned level. Its previous efforts did not bear fruit, and there is also the death cross on the daily chart that we have talked about before, which doesn't leave room for much optimism. This is the daily death cross here, which is often a precursor of sustained weakness. Furthermore, the ECB paused last week for the first time after 10 consecutive hikes. Despite not shutting the door to further tightening, the decision was dovish, and we got the preliminary inflation figures today, which showed further deceleration. Headline dropped below 3% and the lowest level in more than 2 years, while the core eased to 4.3% and the slowest pace in more than a year. So the path of least resistance remains on the downside, and the reason why we see this renewed downward pressure today at these critical levels is, of course, the CPI release. As such, there is risk for renewed 2023 lows, which are at around 1.0447, but further weakness towards and beyond 1.0337 will need further catalyst. Again, the path of least resistance remains on the downside, although we have seen signs of the limitation of the USD strength, and there has been an improvement since the start of the month, let's say, in the technicals. And again, we expect key events ahead, including the Fed. Now let's turn our attention to Wall Street as trading begins, the session begins. NAS 100 comes from an ugly week as investors monitor a series of risk factors and strong US data that support the Fed's higher for longer narrative. And mostly strong big tech earnings last week, which did not help much, however. It rebounds since Friday, but again we see a tentative mood today as it awaits high impact events, including the Fed and Apple, and we're going to talk a little bit more about that right after. The index managed to defend key levels and has the chance to push for the 200 period EMA, the black line at around 14,800, but will need help from the incoming events, and the upside does not look particularly friendly. You can see how starting from the 200 period EMA, the black line, we have many roadblocks. Immediate bias, of course, remains on the downside, and the index is vulnerable to the 38.2% Fibonacci of the 2022 low, 2023 high rally, but we are cautious around further losses past that and towards 12,941. Now let's talk about what's ahead. It's a very busy week with a central bank bonanza that already started with the Bank of Japan, of which we talked about, and now the US Fed picks up the baton on Wednesday. The central bank has maintained a higher for longer stance, and its last projection imply one more hike this year for rates to peak. The economy is very strong, and this was underscored by the 4.3% GDP growth in Q3 according to last week's preliminary data. The labor market remains tight despite coming to better balance. NFPs are due on Friday. We'll have a chance to talk about more around that in Thursday session. And inflation has moderated substantially but remains high, and recent figures have shown resistance. Core PCE was at 3.7% year-over-year in September. However, recent commentary from various voters has undermined the hawkish bias. Markets believe that rates have already peaked and overwhelmingly expect a hold, although they haven't completely priced out another hike in future meetings. As such, focus is likely going to be on what's next. The Bank of England follows on Thursday. It had paused in September after a deceleration in inflation, but the split decision in the non-committal stand create high uncertainty around the outlook. Policymakers have reasons to want to hold again, and that's the baseline forecast. As the economy is in a poor state and borrowing costs have increased substantially. On the other hand, pay growth remains high and the latest inflation figures shows stickiness. The updated projections will also be key. And Apple earnings are due on Thursday. Last week, Amazon impressed, Microsoft impressed, Meta did very well, but its ad warning scared markets, I would say, and Google was probably the biggest disappointment. Of course, you can find written analysis on all of that on our on the FXCM analysis websites of your respective regions. Now focus shifts to Apple, which reports on Thursday. This comes at a challenging period for the company. It has registered 3 consecutive quarters of negative revenue growth and does not expect that to change this time. And large reason, a key driver for that is low demand for smartphone NPCs globally, weak demand, although there are signs of bottoming out. And of course, dependence on China also creates concerns given strained Sino-US relations. Of course, the company is tightly around its artificial intelligence plans, although we have seen that its hardware is advancing so that it can handle such workloads, and we have seen progress on Siri and incorporating AI, but it hasn't announced something big, something that could be eye-watering, let's say, and a pivotal moment. So if it falls back, there is a lot to lose, but if it manages to come out with an AI push, a significant AI push, that could unlock tremendous value. So that's it. That's pretty much it from me for today. Thank you for joining me. We're gonna talk again on Thursday at our usual slot, 10 minutes before Wall Street opens.